Hello and welcome. This is Magicbricks Now, India's first property channel. You're watching Property Hotline. I'm Kavita Krishnan. Today we are answering all your tax queries related to real estate with Ashish Sodhani. Ashish is an associate international tax practice at Nishith Desai Associates. Ashish, welcome to the show. We already have someone who's dialed in. Sunith has called us from Rourkela. Sunith, how can we help you?
Hi, this is Sunith, and I didn't really get the good names. Ashish, I'm told. All right, Ashish, hi. Ashish, it's like this. We normally have this corpus which we get from our retired fund in the Provident Fund. Now, my question is that the corpus that we get back from the Provident Fund after all the interest that has been paid to us, is there a way that we can avoid a tax on it? Because every time, this is the money that's the last money, kind of last frontier for us, in terms of savings when we are, working in a company. So when it comes down to the Provident Fund, we use this fund as our last money for, surviving for the future.
Right, Sunith. How? So essentially you want to know how you can save tax on that Provident Fund money that you will get once you retire.
Correct.
On your retirals, essentially. Just an FYI, this is a show where we answer property tax questions. However, we will answer this as well. Ashish, what can Sunith do?
So unlike in case of a residential property where once we sell and then we have a capital gains benefit, unfortunately over here we do not have that benefit. So the interest would become taxable at some point of time. However, if you have been in the company for more than 5 years, or if you have your EPF continued for more than 5 years, what you could do is that when you receive the payment, you do not have to, the employer does not have to deduct any TDS. So you receive the full amount with yourself, and then any deduction that you are taking generally from your income tax, you could claim that and pay taxes accordingly. But there would be a general interest tax that would be payable in case of you receiving the EPF amount, the interest amount on the EPF.
So you have to pay tax on the interest that you get on your EPF. But very quickly, Ashish, we know that a lot of people in India, it's not a practice that one should ideally follow, but a lot of people do use their money in the PF to fund their homes towards the end of their careers. Now, if you were to do that, if you were to withdraw that entire chunk and invest it in real estate, then is it taxable?
So, there is a small distinction. It is the interest amount and the principal plus the amount that has accrued over the years, right? So, that amount that you're taking out, the principal plus the accrued amount, is not something that is going to be taxable, but the interest amount from your contributions that you have made over the years is the part which is taxable.
So that even if you invested anywhere, you will have to pay tax.
Yes.
Okay. Moving on, email query. G. Shivaramakrishna has written in, says he's purchased an under construction property 3 years ago from the Prestige Group. He will get possession in another 3 months and he plans to sell the property. Now he has deducted the 1% TDS as needed and has paid the remaining amount to the developer. Now, does the buyer need to deduct the 1% TDS from the payment that will be made to Mr. Shivaramakrishna? So, if he's selling it again, is there the TDS to be paid?
So, TDS in case of of immovable property is supposed to be paid by the person who is the transferee, the person who is receiving the property. So, therefore, while you have made the payment of 1% while purchasing the property from the builder, when you sell it back to the builder, he will deduct the 1% and pay it to you. Just one note over here that TDS needs to be deducted only in case the property value is more than 50 lakhs.
Right. So essentially you're saying that whether I buy it from the developer or whether I sell it to somebody, the TDS has to be paid.
Yes.
So every time the property is sold, if it is over 50 lakh rupees, TDS has to be paid, and that's a key takeaway coming for you right on top of the show over there. 1% TDS has to be paid on any transaction on immovable property. That is if the property value is over 50 crore rupees. And Ashish, how long do you have to make the TDS payment?
So the TDS payment will need to be made within the 7th of the next month. It's fairly simple procedure. There is a form 26QB available on the income tax website. You can take a printout of that, fill it up, and deposit the tax to the government.
So even if I were to buy, say, property on the 30th, I would have to ensure that the TDS is paid within the next 7 days.
Right.
So 7th of every month is the deadline to pay your TDS. So you have to pay the TDS within the 7th of the next month after you purchase that property. Also remember, buyer has to pay the TDS, right? Moving on, we now have Mr. Mishra, who's called in from Shimoga. Mr. Mishra, how can we help you?
Yeah, actually, my question is, if I am purchasing a house and I am self-occupied, and it is self-occupied, maximum interest deductible is 2 lakhs. Suppose I am renting it out, what is the maximum deduction possible under Section 24?
If you rent out a house, is this a second house that you bought?
No, first house only.
First house.
And in Section 24 only, and the clause is that in case the property has not been self-occupied by the owner by reason of fact owing to employment, business or profession carried out on at any other place, he has to reside at that other place not belonging to him, then the amount of tax deduction allowed under Section 24 shall be 2 lakhs only.
Right, Mr. Mishra, I think Ashish has some good news for you on that front. I can see him smiling. Let Ashish answer this. Ashish, very prudent from a tax perspective, right? To rent out a house once you buy it.
Sure. So in his case, there is an interest deduction, like he said, for 2 lakh rupees that he will get. Apart from that, since you have taken a loan, the principal amount of the loan also can be available for your deduction. With respect to you having income as rent, so this could be considered to be your income from business or profession. There are various judgments of the Supreme Court and the High Court which have said that this income can be considered to be the income from business profession, and therefore you can take deductions from the income that you are getting as rent. Suppose you have put in furniture or fixture in your house, you can take a deduction for that, saying that you have developed the house for you to get more rent, and therefore you can reduce your tax burden.
Also, so furniture fixture is something that you can claim. What about, the stamp duty that he has paid on the house and whatever other costs he's running? I mean, if you let out the house,
right,
you would be paying maintenance. So if you consider it as business income, it were to follow that this is business expenses.
Absolutely.
So can he actually claim deduction
yes,
that as well?
He can claim that as expenditure, and he can claim that as a reduction from his rent income and then pay taxes only on the reduced amount.
Could you explain what is this reduced amount? Could you break it up further for Mr. Mishra and for all our viewers?
Sure. So if you are earning a rent of 1 lakh rupees a month, but say you have paid 15,000 rupees as maintenance charges or charges with respect to buying furniture, fixtures, etc. to develop the house, to improve the house, the cost of improvement, then you could reduce that much as your expenditure from the 1 lakh rupees and pay tax only on the reduced amount.
So what you're essentially saying then, Ashish, is that the number of deductions that you can actually claim goes up.
Right.
It is not just the deduction that you get on the interest and on the principal amount which everybody gets in any case.
Sure.
You can also claim deduction on the maintenance that you pay, on the money that you spend for furniture and fixture, etc.
Right. Just the deduction in this case would be from the rent income, and the deduction on the interest would be from the salary that you are getting from your employment.
Okay. Moving on, Yassine has written in on email. Now he says that he plans to buy a ready-to-move-in apartment and the builder is asking him to pay 6 lakh rupees as VAT. Now he wants to know if he should pay this amount. Should he pay the VAT? The VAT is something that you are mandated to pay, right?
Right, but VAT is only payable in case of an under construction property, and it is only payable to the extent the property is under construction. So to give you an example, if the property has been constructed to 70% but 30% is only remaining, then you need to pay VAT only to the extent of 30%. For the remaining 70%, because it has already been constructed, there should be no VAT payable. And in his case, since it's a ready to move in flat, and if the completion certificate has been provided, then there should not be any VAT payable.
Okay, I want to bring you back to what you said, the 30-70
right.
thing. So if I buy into an under construction project, and say when I buy into an under construction project, what you're essentially saying is if 30 or 40% of the construction is complete,
right,
then I pay VAT only on the amount of money that I'll be paying for the remaining, the balance 60%. Is that right?
That is the amount that is the percentage that is remained to be constructed.
So whatever is left to be constructed, right, I just need to pay VAT on that, and not on the entire cost of the
Absolutely.
flat. And for this, I will need to show an architect certificate when I file my returns, saying that I bought this property at so and so stage.
Right. The architect certificate will be required also to calculate the amount of the construction percentage, the under construction property, you can take the details from the builder, who can provide you the cost of construction material that he has bought, and you can pay taxes accordingly on that amount.
Right, so that's another very, very big takeaway for you, for all our viewers. In fact, if you are buying under construction property, ensure that you know at what stage you are buying into, what stage the property is in when you sign on the agreement, and also get an architect's certificate to that effect at the time of signing that agreement. You can then show it to the tax authorities when you actually go on to, pay the VAT, because you do not need to pay VAT on the entire cost of the house. You have to pay VAT only on the cost that you will incur from the date that you're buying the flat. So if 30% is, say, ready, 70% of the construction is still left to be done, you have to pay tax only on that 70% and not the earlier 30% as well. This is something that a lot of people, in fact, this is news to me as well. And, I know of a lot of people who go buy a property that is almost nearing possession, which
VAT.
means 80% of the work is done, and they end up paying VAT on the entire cost, because nobody is actually telling them this, which is also why you should, get a tax consultant to actually look at all your papers. Moving on, Mahindra Mehta has dialed in from Goa. Mahindra, how can we help you? Mahindra, if your TV is on, you will need to switch it off. Mahindra, can you hear me?
Yes, sir.
If your TV is on, you'll need to mute it. You'll need to mute the volume.
Deduction on the partnership firm which has been taking out the property is more than 1.5 crores. So whether it is applicable to individual or to the people.
Very interesting question. Partnership firm is buying property. Who has to pay the TDS on that? The partner, the individual partner, or the firm?
So the way the Income Tax Act has been worded, it says any person responsible for paying or purchasing property. Person has been defined as an individual or a partnership or a company. Therefore, even a partnership firm which is buying property in its own name will need to pay the TDS as a partnership firm to the government.
So if it's essentially you're saying whoever's name is on the agreement has to pay the TDS.
Absolutely.
So if the firm's name is on the agreement, Mahindra, then the firm has to pay the TDS. If your name, for instance, is on the agreement, then you will have to bear the TDS cost. And is it the same for both for a company and for an individual?
Absolutely. It's absolutely the same, as well as a 50 lakh threshold amount applies for a company, firm, or an individual.
Let's take an email query next. Jalal has written in. He says he owns a home in Mumbai and wants to buy another house. Now he plans to sell his current home and invest 50% of the amount in a new house. He plans to keep the remaining 50% of the amount in the bank. Now he wants to know about the tax impact on the same. Ashish, this sounds like some retirement planning going on over there. What is the tax impact if he keeps money in the bank?
Right. So for the 50% amount that he wants to reinvest, since he's going to buy another residential property, the 50% can be reinvested within 3 years into a construction or residential or a purchasing of a residential property, and there should not be any tax on that. The remaining 50%, he has the right to keep that 50% in a bank account, and he can show it in his books as the money that he has received from the sale, the capital gains. He has the ability to use this 50% amount in the next 3 years for purchasing or constructing a residential property. He can put money in the property that he has already purchased or is constructing, which is the residential property. But if he does not utilize this 50% in that, then the 50% becomes taxable as capital gains.
So 50% will become taxable as per capital gains. And how much tax would he have to pay on that?
So if it is a long-term property, I assume it will be long-term property, it will be 20%.
20% is what you'll have to pay. However, like I said, it does sound like he's trying to do some kind of retirement planning over there. What are the other options where he can actually save on capital gains? What other instruments can he probably
So, in fact, in his case, when 50% is being utilized for purchasing another property, the remaining 50%, if it is within the 50 lakh amount, he can purchase it in long-term bonds of the government, which would again be tax-free.
Long-term bonds of the government, which would be tax-free. I have another problem with this question. Now, Jalal says that he's going to take the money that he's getting out of the sale of his house, invest 50% in the property, and put the remaining 50% in the bank. Now the entire 100% will not be capital gains.
Right.
Right. So could you just break down for Jalal and for all our viewers what capital gains tax exactly taxes?
Sure. So let's assume that when Jalal bought the property, it was for 50 lakhs. Today, when he is selling it, it is for 1 crore. So the cost of acquisition minus the sale price minus the cost of acquisition. So therefore, 1 crore minus 50 lakhs, that is 50 lakh of rupees that he is making is the capital gains, and the tax needs to be paid only on the capital gain of 50 lakh rupees. So out of that 50%, that is 25 lakhs, can be reinvested without payment of any taxes. The remaining 25 lakhs can be invested in long-term bonds, on which again he will not have to pay any tax.
Right. So Jalal, that's the breakdown for you. Capital gains essentially means the profit that you earn by selling property. To make it simpler, in Hindi we call this munafa. So profit or munafa that you earn when you sell property is what is being taxed over here. It is not the entire sale proceeds, or it is not the entire money in hand that you get after selling property. So it is that essentially that portion of the money which is being taxed, which you have to reinvest in a residential property or in capital gain bonds to ensure that you save on taxes. Moving on, we have a question coming in on our website www.mbnow.in. Now Shobit writes in and he wants to know how service tax and VAT are calculated on under construction property. We've answered part of it already, but
right.
That's our other
So on the VAT, just quickly going back, VAT is only payable on the under construction part of the property. So giving the same example, if 70% is already constructed, you need to pay tax only on the remaining 30%. Similarly, for service tax, it is only payable for an under construction property and not for a completely ready property. In the case of service tax, the mechanics are slightly different. Let's assume that the cost of the formula that is provided today is that in case of a property which is less than 1 crore, 75% is, you are not supposed to pay service tax on 75%, but only on the 25% of the value of the property. However, in case the value of the property is more than 1 crore, then you get an abatement of 70% and you need to pay tax only on the 30%.
Right. So you have to pay tax. Remember, the VAT is payable only on that portion of the property which is currently under construction when you sign that dotted line. We have another email query coming in. Salim says that he sold his plot for 30 lakh rupees. Now this plot was registered in his name. His sons, however, plan to buy a property jointly, which I'm guessing they're doing after the sale of this property, which is registered in Salim's name. Now Salim wants to know what is the time limit to reinvest and buy another plot or house. I have another question that I want to add, Ashish, over here. Can his sons actually sell the plot of land that is in Salim's name, the property in Salim's name, and use the reinvest those gains in another plot or house in their names and claim deduction? Is it possible?
Right. So I was going to come to that. While he can sell the property, the capital gains can be utilized by him and only him to purchase another residential property. He cannot have the sons purchase another property to get the capital gains tax benefit. So it is advisable that he purchases the property from them first and then maybe gifts it to the sons.
Okay, so he can purchase a property and then gift it to his sons, or can they do it the other way around? That he gives this existing property to his sons first and then they sell it and purchase another property?
Absolutely.
Is that also possible?
Absolutely possible.
So essentially the property is transferable, the gains are not. So if the gains are in Salim's name, Salim, you will have to pay the tax on those gains. Next query comes in on our website mbnow.in. Meena Mulani has written in. Now she says that her elder daughter, who's an NRI, is lending money to her younger daughter in India as a loan to buy property. Now Meena's younger daughter plans to return that amount on a monthly or a quarterly basis. Is there any tax implication on Meena's elder or younger daughter? How can her younger daughter return this money to the elder one?
Right. So lots of questions there. Let's break it up. First of all, there is an NRI to resident loan that is being made. While this should be possible, but however, this is a regulatory issue, so you should also get it checked from your chartered accountant who can, do the paperwork for such a loan to be made. That being point one. Point two, the money can be returned back. There are two ways to return this money back by the younger sister. One is that she can put the money into the NRO account of the non-resident Indian sister. An NRO account is a non-resident ordinary rupee account that the NRI sister would usually have in India. Once the money is put into the NRO account, the elder sister has the ability to take out $1 million from that account every year. That being point one. Point two, she could also use the liberalized remittance scheme provided by the Reserve Bank of India, wherein the younger sister can send $250,000 to the elder sister with just doing minimum paperwork. However, this is available only for per financial year. So if you want to make more remittances, it needs to be made after the year is over. With respect to the taxation, so the loan that is being given to the younger sister, she will have to pay taxes on the loan that is taken, and the interest amount that is paid to the elder sister would be taxable in the hands of the elder sister, since this is an income which is sourced from India. Therefore, she would have to pay taxes on that amount in India.
So essentially, even if it is her sister returning the money that she owed to her, she'll have to pay taxes on that. Is there no way of getting out of it?
So there is an interest payment that is taking place essentially, and therefore there will be an...
And what if, say, Meena's younger daughter is not paying any interest? I mean, I doubt, in most families, if the elder sibling were to give money to the younger sibling, I don't think people charge it as the entire, the point of taking money from your relatives, and that too your blood relatives over here,
right,
is that you don't need to pay interest. Otherwise, I could just go to a bank and take the money.
Absolutely. So in that case, what would be suggested? Not to term it as a loan, but to term it as a gift to your younger sister, which is repayable, and the younger sister then repays the amount according either to the NRO account or to the liberalized remittance scheme.
Okay. Now you're saying term it as a gift that is repayable.
Right.
So do they have to do any paperwork over here?
So, because the payment is being made from a foreign country into India, there will be some amount of paperwork that will need to be done and submitted to the Reserve Bank of India.
No, I'm not talking about the financial transaction paperwork. What I'm asking is to basically if they want to get out of paying tax.
Right.
And you said they can do that
right.
by showing it as a gift.
Right.
Which she is going to repay.
Right.
So, is there anything, do they have to prepare a gift deed or something
right,
like that?
So a gift deed would usually be helpful. It could be a small one-pager, just stating that it is out of natural love and affection that a payment is being made by the elder sister to the younger sister. Similarly, when the younger sister returns back the money, she could do the same thing for the elder sister.
Okay, so you have to make the gift deed, you have to register this as well. Should it be made on stamp paper? How do you go about it?
You could do it with minimum stamp paper. You do not need to get into paying the exact amount of stamp duty, since it is between the sister and the between two sisters. Therefore, you do not need to go ahead and pay the full amount of stamp duty.
Okay, so Meena, essentially you need to ask both your daughters to make a gift deed. Now your elder daughter makes a gift deed saying that she is sending X amount of money, she is gifting X amount of money to her sister when she actually lends her the money, and when your younger daughter is in a position to return that money, then she goes ahead and makes another gift deed saying that she is gifting X amount of money to her sister. Now both these gift deeds, like Ashish just told you, can be made on a minimum value stamp paper. Do ensure you register it, and do ensure that both your daughters have copies of this with them, which they can show to the tax authorities when they do file their returns. Right? With that, it's time for our key takeaways. Quite a few key takeaways that came out of our show today. The important one being that 1% TDS that you need to pay. Now, this is something, Ashish, a lot of people are, confused about. In fact, a lot of people don't even know that this 1% TDS exists, because there isn't much, it was just an announcement, a small little announcement that came in the budget papers, and most have missed it. So there, you need to pay 1% TDS on any transaction of immovable property, and if the transaction is over 50 lakh rupees, which means if you're buying or selling property, and if you're buying property and you're paying over 50 lakh rupees for that property, you need to deduct 1% TDS on it. Now this 1% TDS will have to be paid again when you sell that property, but this time it will have to be paid by the buyer. So in every transaction, the TDS will have to be paid, but it will be paid by the buyer. So this is a key thing that you need to remember if you are in the market to buy property. Then the other key takeaway that we learned today on the show was that you need to know the stage of construction when you're buying a home, And this is very, very important, not just to know when you are going to get that home, when you're going to get possession of that home, also to calculate the amount that you will be paying as VAT. You do not need to pay VAT on the entire cost of the home. You need to pay VAT only on the cost of the home, only on the money that you are paying for the rest of the construction. So if you buy a property, for instance, that is 80% complete, then you need to pay VAT only on the remaining 20% amount that you will be paying for the construction of the property. Ensure that you ask for the architect certificate when you're buying that house, so that you can show it to the tax authorities when you pay that VAT. That's all the time we have on today's episode of Property Hotline. Ashish Sodhani, thank you very much for coming in and breaking down and answering all those questions for us. If you have any questions related to real estate, remember it's not just tax. Whether it's about buying, selling, investing in property, legal issues, or even home finance queries, you can reach us, IDs flashing on your screens. We'll get the country's top experts to answer each and every one of your questions. That's a promise. Keep watching Magicbricks Now.
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/magicbricksnow. And don't forget to click the like button. You can also follow us on Twitter at magicbricksnow. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/magicbricksnow.